The emergency fund your first financial priority. Have you ever wondered what would happen if you suddenly lost your job, faced a medical emergency, your car broke down, or an unexpected home report demanded thousands of dollars overnight? Life is unpredictable no matter where you live or how much you earn. Unexpected expenses eventually arrive. The difference between financial stability and financial stress is often not income, it's preparation. That preparation begins with one simple but powerful financial tool, an emergency fund. Many people think investing should come first. Others focus on buying expensive assets or chasing high investment returns. While those goals are important, they become difficult to sustain when emergencies force you to borrow money or sell investments at the wrong time. That's why financial experts across the world recommend building an emergency fund before pursuing aggressive wealth building strategies. In today's video, we will explore what an emergency fund is, why it should be your very first financial priority, how much you should save, where to keep the money, how to build it step by step, common mistakes to avoid, and how this single habit creates long term financial freedom. By the end of this video, you will understand how a simple savings can protect your future, reduce stress, and keep your financial goals on track. What is emergency fund? An emergency fund is money set aside exclusively for unexpected and unavoidable expenses. It acts as a financial safety net that protects you from life's surprises. Unlike money saved for vacations, shopping, gadgets, or celebrations, an emergency fund has only one purpose: to help you survive genuine emergencies without borrowing money or selling your investments. Think of it as financial insurance that you create for yourself. Emergencies come in many forms: losing your job, sudden medical expenses, urgent vehicle repairs, emergency travel to help family, or major home maintenance can happen without warning. These situations require immediate cash. If you don't have savings, you may rely on credit cards, personal loans, or borrow from friends and family, creating additional financial pressure. An emergency fund provides peace of mind because you know you have resources available when life becomes uncertain. It allows you to focus on solving the problem instead of worrying about where the money will come from. Example: Sarah works as a marketing executive. One morning, her car's transmission failed, costing $2,000 to repair. Because she has an emergency fund, she pays the repair bill immediately and continues going to work without taking a loan. Her savings protected both her finances and her career. Next, point number two: why everyone needs an emergency fund. Unexpected events do not discriminate based on age, profession, or income level. Students may face medical emergencies, employees may lose jobs, freelancers may lose clients, business owners may experience declining sales, and retirees may encounter unexpected healthcare cost. Financial uncertainty is a universal part of life. Without emergency savings, even a relatively small expense can disrupt your budget. Many people begin using credit cards for emergencies, but high interest debt often becomes harder to repay than the original expense itself. What begins as a small problem can grow into years of financial stress. An emergency fund gives you flexibility and confidence. Instead of making desperate financial decisions, you can take time to choose the best solution. This protection reduces anxiety, improves financial discipline, and allows you to continue working toward your long term goals. Example: David unexpectedly loses his job due to company restructuring. Because he saved 6 months of living expenses, he has enough time to search for a suitable position instead of accepting the first low paying opportunity that appears. Next, point number three: how much should you save? The ideal size of an emergency fund depends on your financial situation. A common recommendation is to save 3 to 6 months of essential living expenses. This includes rent or mortgage payments, groceries, transportation, insurance, utility bills, healthcare, and minimum debt payments. People with stable employment may feel comfortable with 3 months of expenses. Those who are self employed, freelancers, seasonal workers, or business owners often benefit from saving 6 to 12 months because their income can fluctuate more significantly. The important thing is not reaching the perfect number immediately. Start with a smaller milestone, such as saving $500 or $1,000. Once you reach the total goal, continue building gradually until your emergency fund provides adequate protection. Let's say example: Maria spends $2,500 each month on essential expenses. Her goal is to build an emergency fund of $15,000, representing 6 months of living cost. She reaches this target by saving consistently over several years. Next, point number four: Where should you keep your emergency fund? An emergency fund should be safe, accessible, and separate from your daily spending account. This money is not meant for investing in volatile assets because emergencies require certainty rather than high returns. Many people choose high yield savings account, money market accounts, or other secure banking products that allow quick access while earning modest interest. The primary objective is preserving capital and maintaining liquidity rather than maximizing investment performance. Keeping emergency savings separate also reduces the temptation to spend the money on non essential purchases. A dedicated account reinforces the psychological commitment that these funds exist only for genuine emergencies. Let's say example, John keeps his emergency savings in a dedicated online savings account. When his washing machine suddenly breaks down, he transfers the necessary funds immediately without disturbing his investment portfolio. Next, point number 5, how to build an emergency fund step by step. Building an emergency fund becomes manageable when broken into small, consistent actions. Begin by reviewing your monthly budget and identifying unnecessary spending. Even modest savings accumulate significantly over time when combined with consistency. Automatic transfers is one of the most effective strategies. Schedule a fixed amount to move into your emergency savings account immediately after each paycheck arrives. By paying yourself first, saving becomes automatic rather than optional. Increase your contributions whenever your income grows through rises, bonuses, freelance work, or tax refunds. The process may seem slow initially, but persistence creates meaningful financial security. Let's say example, Emma automatically transfers $100 every month into her emergency fund. She also deposits annual bonuses into the account. Within 3 years, she has accumulated over $5,000 without feeling financially overwhelmed. Next, point number 6, what qualifies as a real emergency? One of the biggest challenges is distinguishing between genuine emergencies and ordinary ones. An emergency fund should only be used for unexpected, necessary, and urgent expenses that cannot reasonably be postponed. Unexpected medical treatment, emergency home repairs, essential vehicle repairs, or temporary income loss qualify as legitimate emergencies. On the other hand, vacations, holiday shopping, luxury purchases, entertainment, or upgrading electronic devices should never be funded from emergency savings. Maintaining this discipline preserves the integrity of your safety net. Every withdrawal should be followed by a plan to rebuild the fund once the crisis has passed. Let's say example, Michael wants to buy the newest smartphone, but his current phone still works. Although he has enough money in his emergency fund, he chooses not to touch it because the purchase is a desire rather than a necessity. Next, point number 7, common mistakes people make. Many individuals either postpone building an emergency fund or misuse it after saving. Some believe emergencies will never happen, while others invest all their cash, leaving nothing available for immediate needs. Another common mistake is using emergency savings for planned expenses such as holidays, weddings, or annual insurance payments. These predictable expenses should have separate savings categories. Waiting until income increases before saving is another trap. Building the habit of saving matters far more than the amount saved initially. Consistency creates financial resilience over time. Example, Lisa spends her emergency savings on a luxury vacation. Months later, she experiences an unexpected medical emergency and must rely on expensive credit card debt because her financial safety net no longer exists. Next, point number 8, the emotional benefits of an emergency fund. Money affects more than bank balances, it also affects emotional well being. Financial uncertainty often creates stress, anxiety, relationship conflicts, and reduced productivity. Knowing that you have emergency savings provides confidence and emotional stability. An emergency fund allows better decision making during difficult situations because panic is replaced by preparation. Instead of worrying about immediate survival, you can focus on solving problems logically and calmly. Financial security also improves sleep, strengthens family relationships, and encourages healthier long term financial habits. The emotional value of an emergency fund often exceeds its monetary value. Example, after building 6 months of savings, Kevin feels less anxious about workplace uncertainty. Instead of hearing every company announcement, he knows he has time to adapt if circumstances change. Next, point number 9, how emergency funds support long term wealth. Many people assume emergency funds slow down investing because money remains in low risk accounts. In reality, emergency savings make investing more successful by preventing forced withdrawals during financial crisis. Without emergency reserves, investors often sell stocks during market downturns simply to pay bills. This locks in losses and interrupts long term wealth creation. Emergency funds protect investment portfolios by covering unexpected expenses separately. A strong financial foundation also encourages disciplined investing because you know short term emergencies will not interfere with long term goals. Let's say example, during a recession, Daniel loses his job while stock markets decline. Instead of selling his investments at a loss, he uses his emergency fund for living expenses until he secures new employment. Next, point number 10, your action plan starting today. Building an emergency fund begins with one simple decision. Start now, calculate your essential monthly expenses, determine your savings target, open a dedicated savings account if necessary, and automate regular contributions. Remember that financial success is not achieved through one large action but through many consistent small actions repeated over time. Every contribution strengthens your financial safety net and brings greater confidence. Celebrate each milestone, whether it's your first $100, first $1,000, or 6 months of living expenses. Progress matters more than perfection, and every step forward improves your financial resilience. Let's say example for this point. Alex starts by saving just $25 each week. Though the amount seems small, after 2 years of consistent saving, he has enough money to handle unexpected medical expenses without borrowing or disturbing his financial goals. Finally, life will always present unexpected challenges, but financial emergencies do not have to become financial disasters. An emergency fund is one of the simplest and most powerful tools for protecting your financial future. It prevents debt, reduces stress, preserves your investments, and gives you the freedom to make better decisions during difficult times. Whether you earn a modest income or a high salary, building an emergency fund should be your first financial priority. Start small, remain consistent, and allow time to work in your favor. The money you save today may become the reason you avoid financial hardship tomorrow. If you found this video valuable, don't forget to like, subscribe, and share it with friends and family. Every great financial journey begins with one small decision, and building your emergency fund is one of the best decisions you can make. Thank you for watching, and I will see you in the next video.